Hey everyone, and welcome back to the AI Tech channel. Are you feeling that sense of unease in the market? That feeling that something's got to give? Well, you're not alone. We're at a critical juncture, and next week is shaping up to be a real make-or-break moment. But is it a crash? A minor correction? Or is the AI rally going to defy gravity? The smart money is betting on a major shift. The whispers on Wall Street are getting louder, and the data is painting a very clear picture. We're talking about the potential for a huge market swing, a correction that could wipe out months of gains, or a continuation of this insane AI-fueled rally. Buckle up, because this is going to be a wild ride. Let's dive into the first potential catalyst, Nvidia's earnings. Remember when Nvidia practically single-handedly carried the market? Those days might be fading. Their stock is only up 4% this year, a far cry from the astronomical gains of the past 2 years. Now, everyone's waiting to see if Jensen Huang can pull another rabbit out of his hat. The anticipation is tangible. You can feel it in the air. But there's a real chance that Nvidia could disappoint. DeepSeek's emergence in China has rattled the market, raising concerns about competition. And if Nvidia stumbles, it could drag the entire tech sector down with it. Think about it. Nvidia's success is almost too priced in. It's a classic case of price to perfection. The market's expecting a miracle, and anything less could trigger a massive sell-off. This isn't just about Nvidia. It's about the entire AI narrative. Can Nvidia still justify its sky-high valuation? That's the million-dollar question. And speaking of tech, what's going on with the Magnificent Seven? They're not so magnificent anymore, are they? Tesla's tanking, Apple and Alphabet are struggling, and even Microsoft is showing signs of weakness. Only Meta and Amazon are holding their own. The market's relying on energy, healthcare, and financials now. Can these sectors really sustain the bull run without the support of tech giants? To me, that's a big question mark. The market breadth is narrowing, meaning fewer and fewer stocks are driving the gains. That's a classic warning sign of an impending correction. It's like a car running on fumes. Eventually, it's going to stall. And without tech leading the charge, the overall market could be in serious trouble. We're seeing a clear rotation out of tech and into other sectors. But is this a healthy rotation or a sign of a deeper problem? Analysts are all over the place on Nvidia. Deutsche Bank is staying neutral, while others are predicting a significant upside. But even if Nvidia beats expectations, Jensen Huang needs to reassure investors about DeepSeek and tariff uncertainty. It's not enough to just deliver good numbers. He needs to paint a convincing picture of the future. He needs to quell the fears, address the concerns, and show that Nvidia can maintain its competitive edge. This earnings call is going to be a high-stakes performance. He needs to convince the market that Nvidia's growth story is still intact. Otherwise, we could see a sharp correction in the stock price. This isn't just about the numbers. It's about the narrative. Now, let's talk about the other big event next week, the PCE data. This is the Fed's preferred measure of inflation, and it could have a huge impact on interest rates. Remember those hopes for multiple rate cuts this year? Those hopes are fading fast. If the PCE data comes in hot, it could completely wipe out any expectations of rate cuts. And that would send shockwaves through the market. We've already seen the CPI and PPI surprise to the upside. If the PCE follows suit, it would confirm that inflation is stickier than the Fed thought. And that means higher interest rates for longer, which means less liquidity, slower economic growth, and potentially a market correction. The stakes are incredibly high. This is the last inflation report the Fed will see before their March meeting. It's their last chance to adjust their policy expectations. And the market will be hanging on every word, every decimal point. The key thing to watch next week isn't just the data itself, but the market's reaction to it. If we see a false breakout above 6,100 on the S&P 500, that could signal a deeper pullback in March. The market's been incredibly resilient, but that resilience can't last forever. The question is, what will be the catalyst that finally breaks the camel's back? Will it be a disappointing Nvidia earnings report? Will it be a hot PCE number? Or will it be something completely unexpected? The market's a complex beast, and it's always full of surprises. But one thing's for sure, next week is going to be a pivotal moment. We're either going to see a continuation of the bull market or the start of a significant correction. And don't forget about tariffs. Steve Cohen, the chairman of Point72, is turning bearish on the economy because of Trump's aggressive trade policy. He argues that tariffs are essentially a tax, and they'll lead to inflationary pressures and lower consumer spending. On top of that, he's worried about slowing immigration, which could constrain the labor supply. Cohen thinks the market's due for a pullback, and he sees the economy slowing down in the second half of the year. He believes we're seeing a regime shift, and the best gains have already been made. It wouldn't surprise him to see a significant correction. I think he's right to be concerned. Tariffs are a wild card, and they could have a significant impact on the economy. They could disrupt supply chains, raise prices, and ultimately hurt consumers. This is a risk that the market seems to be overlooking. And speaking of global risks, let's not forget about China. Professional investors are staying away from Chinese stocks, despite the government's stimulus measures. They're worried about Beijing's repeated interventions in the market, and they're frustrated with valuing stocks based on government policy rather than fundamentals. The Pando CMS Innovation ETF sold out of its positions in Chinese companies because they couldn't predict the government's next move. They said they'd rather embrace certainty over uncertainty. That's a powerful statement. It shows that investors are losing confidence in China's stock market. They're worried about the lack of transparency and the government's heavy-handed approach. And that's a major headwind for the global economy. So what should you do? Should you sell everything and run for the hills? Should you double down and buy the dip? The answer is, it depends on your risk tolerance and your investment goals. But here are a few things to consider. First, review your portfolio and make sure you're comfortable with your asset allocation. Second, consider diversifying your investments to reduce your risk. Third, stay informed about the market and the economy. And fourth, don't panic. Market corrections are a normal part of the investment cycle. They can be scary, but they also present opportunities to buy good companies at lower prices. The key is to stay calm, stay disciplined, and stick to your long-term investment plan. This is a time for caution, but also for opportunity. All right, everyone, that's it for today's analysis. Remember, next week is going to be a crucial test for the market. Nvidia's earnings and the PCE data will set the tone for the next few months. So, stay tuned, stay informed, and be prepared for anything. And now, I want to hear from you. What are your thoughts on the market? Are you bullish or bearish? What are you expecting from Nvidia and the PCE data? Let me know in the comments below. And don't forget to like and subscribe for more in-depth analysis and actionable advice. Thanks for watching, and I'll see you next time.